Welcome to Private Asset Management's Week in Review. Today is Friday morning, June 3rd. I'm Dillon Hakes. I'm joined by our Chief Investment Officer, David Allen. David, a bit of a mixed week for markets this week, but coming off a strong week last week.
That's right. So we have seen some strength this week, Dillon. Week just toward the end of the week, though, it looks like we're going to see a down week. But it does come after the best week we've seen so far this year in the S&P 500, when the index was up 6.6%.
David, we got a big report this morning. We were talking about it last week. We got a jobs report. What do we learn?
Yeah, the jobs report is the labor market report that's sort of most in focus. And we did get a pretty good report this morning. So 390,000 non-farm payrolls added in May, much more than expected. And we also got a positive revision to April.
Another big news story this week. We heard from Jamie Dimon making some headlines from some comments he made, raising some concern over the economy. How do we reconcile the two? We have a good jobs report. Jamie Dimon's raising a bit of a concern.
Yes, Jamie Dimon, the CEO of JP Morgan Chase, obviously has a pretty good view on economic trends based on the data that his bank controls. So he was in a conference this week and basically warning of a hurricane, an economic hurricane that's on the horizon. Wasn't willing to commit to when that hurricane was going to reach economic shores, but was warning that one was coming. And so given his importance and his awareness of financial markets, it certainly was something that people gave a lot of import to. I think one of the things that was less reported was in those same comments, he mentioned that U.S. consumers have about 6 to 9 months, or put a different way, about $2 trillion in excess savings still on their balance sheets, which they're able to use to finance spending in the current period. So there's a long runway for consumer spending that we see, even if perhaps there are some increasing risks on the economic horizons.
At the same conference, we also heard from Brian Moynihan, who also spoke, CEO of Bank of America. He seemed to throw a little bit of cold water on what Jamie Dimon had to say. I'm pretty sure Brian Moynihan also has a pretty fantastic set of data that he gets a chance to look at. It seems to be a mixed picture we're hearing.
That's right. So, obviously, Jamie Dimon is an important figure in financial markets, but he's not the only figure. And so there are some of his peers who have differing views and more optimistic takes on the economic outlook.
What is Jamie Dimon concerned about? What in the market is he worried about?
So, his concerns are basically the concerns that we've highlighted over the last several weeks. First, the war in Ukraine, the impact that's having on commodity markets, lockdowns in China, and the potential for that to snarl supply chains further and to increase inflation globally. And then finally, here in the U.S., the Fed increasing interest rates to fight higher inflation. So those are the concerns that he had. Those are the concerns that we have, and those are the ones that we're watching closely every week.
Did we hear anything in the jobs report that gave us some clarity on any of those concerns? How about on the inflation picture?
I do think this morning's jobs report provided some support for expectations for a more disinflationary environment here in the U.S. First, we saw labor force participation pick up, not by a large amount, just 0.1%, but certainly moving in the right direction. And as we get more labor supply and sort of some of the heat is taken off of labor demand, we should see lower prices for labor. In the labor market, prices are paid out in wages. And so we are expecting that better participation should lead to lower wages. And that's something that we saw in the labor market report this morning, too. Year-over-year growth in average hourly earnings slowed to 5.2% from 5.5%.
Wages are obviously one component of inflation. The other that we've talked about over the last number of weeks, we've talked about all year, supply chain issues, the big lockdowns in China. Did we learn anything this week that has updated on that picture?
Yes. So we did see some of the lockdowns in China ease. That was a process that began last week, but we saw an acceleration there. So Shanghai is beginning to emerge from its lockdowns, and we've seen some of the reports of citizens returning to their normal lives. As we mentioned before, there's also a pretty significant fiscal stimulus underway in China to support growth there. So both of those should improve growth in China and perhaps smooth some of the bumps that we've seen emerge in global supply chains.
David, are we seeing any data that supports supply chains easing?
So this week, the ISM manufacturing report came out, and one of the sub-indices there is something that tracks supplier delivery times. And we saw that sub-index fall, which suggests that supplier delivery times were actually shortening. It's a good sign. It means that perhaps some of the lockdown conditions in China weren't disrupting supply chains quite as much as we anticipated in May. And as those lockdowns continue to ease, we should see supply chains continue to improve.
David, we've obviously had a tough year this year from a market perspective. It seems like there's a lot of pessimism that's been baked in, a bit of strength last week. It doesn't seem like the data is aligning with all the pessimism that has been priced in. What is your view on the topic?
Yes, as we mentioned in past weeks, S&P 500 valuations are trading at much lower levels than what we've seen over the last couple of years. I think as long as the economic data continues to come in fairly strongly, and we have some good ideas of where the Fed is headed for the rest of the year, we're potentially in line for a rebound in market multiples.
All right, David, what do we have on the agenda for next week?
The big economic report next week is the Consumer Price Index. The increase in gas prices that we saw in May should lead to an acceleration in month-over-month headline CPI gains. But we're going to be more focused on the core side, which excludes food and energy prices. And we're expecting year-over-year growth in core CPI to fall below 6% when the data comes out next week.
We'll look forward to that report. Thanks, everybody, for joining us for This Week in Review. We'll see everybody next week.